Hey folks, it's Dave Burrows. I want to welcome you to Barometer Capital Management's Tuesday weekly webcast. I am Dave Burrows, CEO and CIO at Barometer, and I get the honor each week to kind of take a look at the world top down, pull the lens back, look at the big picture setup for investors, and talk about kind of where we see money getting put to work, which areas have risk, what's changing, and how the pieces kind of fit together. The market's like a giant mosaic. There are so many moving parts, and ultimately, it's really important to listen to the message of the market. We all have views and opinions as to what is happening or what should happen, but there's a lot of smart people out there. They all have a view, and ultimately, it all translates into price. And so we try very hard not to be biased and to listen to what the market is telling us so that we make sure we don't go too far offside. So as always, we start on the equity side. We've been in a structural bull market in the US since 2013. It's been just about 12 years. It's interesting. The bull market that lasted from 1981 to 2000 really was the 20 years of the baby boom's peak savings phase. And if we were to look at the bull market we are in currently, really it's concurrent with the beginning of the millennials' peak earnings years. And if we wanted to follow demographics, you could say this could last to 2035. So a long way from here, 10 years. The millennial cohort is actually bigger than the baby boomers, but we'll have to see. Ultimately, what we want to do is we want to make sure we avoid periods like 2000 through 2013 by picking our spots, or the years 1966 to 81, which was a long, frustrating period for buy and hold investors. So we do think that you have to take advantage of assets when they're being revalued favorably. Each of these blue periods started after a long period where nothing happened. In each case, valuations were built during that period. Earnings multiples contracted. Stocks became very cheap. And when the bull markets, each of these began, you got earnings growth. Sure, there was some structural change that drove things, yes. But investors slowly became comfortable paying a higher and higher multiple of earnings. So as you move along in a bull market, people are constantly going to be concerned about valuations because they're higher than they have been for the last several years. And this is really no different. S&P has been marching its way higher. It's been lower bound by a rising 200-week moving average, which would be an important line in the sand to watch. But we're nowhere close to that today. The S&P made a recent low back in October of 2022. We've been trending higher ever since. And as we go out today, the S&P goes out at a new all-time high. Now, we all know that an index doesn't tell you everything you need to know because the largest companies have an inordinately large impact on the index number. As we sit right now, of course, the top 7 or 8 companies have a massive impact on what happens in the index. So we spend a lot of time looking underneath the surface to see what's happening from a breadth perspective, what's happening to the average company to understand the health of the market. Now, we've just gone through earnings period. 454 companies out of 500 have reported. Revenue growth was up just about 6% on the quarter. Earnings growth 11.4%. And that's a lot better than what was expected as we came in. Revenues surprised by about 2%, but earnings came in about 8.5% ahead of estimates. So, of course, there's been lots of things for analysts to worry about, a lot of unknowns, things like the tariffs, things like geopolitical strife in other parts of the world. And analysts are human. They have to assess what they think the risks are to earnings and revenues. We like to look at earnings revisions. And if you look at, as we came into the earnings period in March, the revisions went sharply higher as companies started to report. You can see the market kind of took off and the market continued to move with the revisions in the second quarter. So here we are at new highs. And now we have to watch the revisions for the third quarter. Now, last week we mentioned we'll be watching coming out of earnings, what's happening with earnings estimates, revisions. Actually, Revisions went slightly lower for this upcoming quarter over the course of this week. But if we look at S&P upward earnings revisions as a percent of the total revisions for the forward 12 months, it's pretty steadily been moving higher. About 65% of the revisions have been higher. So that's certainly encouraging. But that's, again, one piece of the puzzle. NASDAQ went out at a new high today, NASDAQ 100. Interestingly, only 44% of the companies inside the NASDAQ 100 are in uptrends. That's a narrower breadth condition than we've seen in a while, but there's some world beaters in that index and companies that are showing no sign of slowing down. We've been watching the equally weighted S&P 500, so the average company, and the fact that it has not been able to make new highs since it made highs last November. Had a pretty good day today. We'll see whether that can follow through. And we've been watching the Russell 2000, so the small and intermediate sized companies. And again, lower highs on each rally going back to November of 24. But again, quite a good day today. So we'll see whether maybe over the next week we can get up and through these most recent highs. All we can do is take the information as it comes, we factor it, we watch the sector behaviors, we watch where the money's flowing, we watch the breadth data. And our job is to make sure that we recognize change as it's coming. Now, one of the big changes we focused on now for the last 2 years is what's happening in global stocks. This sideways period we've been through is a lot like the period that the S&P went through from 2000 to 2013, not making new highs. And we know what happened to the S&P after it finally did make a new high. Well, it's 10 years now. Market's been rallying, and that would not be unusual for what's happened. So whether we're looking at the MSCI Eurozone, this is the month of August. So after a month of July where it was kind of quiet, pretty good blast off here higher in the month of August, in particular in the last couple of days, very strong. We look at Japan. Now, this is a really long-term chart. This chart goes all the way back to 1968. Now, great time to be invested in Japan, starting in 1968. By 1988, people thought Japan was going to own the world, and the market went up 2,896% over just about 8,000 days. That is a structural or secular bull market. And things get overcooked. And it took 33 years to digest all of that. But look at this. Here we are, the last number of months compressed together because it's a very long chart, but today going out at a new all-time high. So that makes us pretty bullish international stocks. There's no shortage of ownership of US stocks by investors around the world. It was the only game in town from 2013 until the last couple of years. But the small company portion of the Japanese market, you could look at the TOPIX 1500. This is a fund that mimics that, is up 37% year to date. And if you look inside the TOPIX, over 50% of stocks a couple of weeks ago were trading at a new 20-day high. And that's happened at times when the market actually was about to lift off. So when we look at the percent of stocks in the Japanese market trading above their 200-day moving average, or a really good measure of long-term trend, last week it was 75. This week it's 82% of companies, and we're just breaking out again. So, when I see a good-looking stock chart, the first thing I want to do is look at what's happening to its peers. Very often, what's a good stock chart just breaking out might be the laggard out of 7 or 8 stocks that have been rallying for a year already. Of course, you want to own the leader, not the laggard. Well, the Japanese market's way outperforming the US market right now, and certainly underowned. And certainly even domestic investors in Japan have been more focused in the US than they have been in their own market because of a strong dollar. Singapore today up 3.3%. Now that was on the back of some earnings from Sea Limited, the second biggest company. It's a company we happen to own. I'll talk a little bit about later. But there's a lot going on globally. That's the Singapore ETF going back to 2008. We're just breaking out, up 28% year to date. That's the Asia Stocks 50 index, 50 largest companies in Asia, sharply higher. Peru, having a great month of August. Well, lots of mining companies in Peru, and mining companies are doing quite well. Argentina, we've talked a little bit about. It was one of the first global markets to break out back in 2022, based on some of the economic changes the current government's been putting in place, and certainly they weren't uh, they weren't very uh, uh, very attractive when it started, and a lot of concerns around what Malay was doing. But certainly it's worked out well for the economy and unemployment. Even emerging markets, as I mentioned last week, have started to wake up, and we went out today basically at new highs. So when these markets start to outperform after underperforming for a long time, it can go on a long time. Last bull market in global stocks started in 2000 and went on for a decade. And we are seeing that certainly over the last 18 months. If I look around the world, the number of global markets in clear uptrends is overwhelming. Now, remember that when a sector turns higher, maybe only 15 or 20% of stocks will be performing well, and that's great. But when the market gets strongest, 70 or 80% of stocks are doing well. It's the same for an asset class. When one market's doing well, like the US, that's great. But if you've got equity markets around the world rallying, it tells you something more. So that's a very healthy sign. So there's the Vanguard FTSE All World ex-US Index, again, only 4 months having made new highs, going back to 2008. So early days, and we think the opportunity is one that could last a decade or more, and it's one we certainly want to try and take advantage of. Even the TSX, as we've talked about, is way outperforming US markets so far year to date in the last 4 months, just marching higher, staying above all these moving averages. So one of the big concerns is tariffs, and we hear all these headline numbers, but I thought this was an interesting number. We highlighted it last week. The tariffs in Canada is supposedly 35%, but of course that's on all the things outside the USMCA agreement. And actually, if you do the math, the total is about 4% tariffs across the Canadian economy. So for some industries, it's going to be very difficult. Steel and aluminum, that's going to be a tough time. But this is something probably Canada can handle. And in fact, if you look at Canada and Mexico, we probably so far have got off about the lightest that any countries have got off in this tariff regime. So MSCI All World Index versus the equally weighted S&P consolidated for 4 months after breaking trend that went all the way back. But this monthly bar is starting out very strong. We'll see what it looks like by the end of the month, but my guess is global stocks are reaccelerating on the back of a weaker US dollar, same for the TSX. So we have to be careful about getting too bearish, reading headlines about what's changing. Very often markets digest the information and add it to what else is going on structurally, and the outcome is not what people expect. So we're having a great start in our global fund over the last 18 months, well ahead of the MSCI index. We expect it to continue. Now, on the rates front, we got CPI data today. It came in as expected, the core slightly hotter. But for the people who are really concerned about a really hot inflation number, that did not happen. So the expectation that we'll get a rate cut increased from about 65% to about 85% for the month of September. But I want you to look at the 30-year yields. This includes today. This is the TLT long bond ETF. Again, last September, the US cut rates and the yield on a 30-year bond went up for the first time in 40 years. Today, the probability of a rate cut September went up and bond yields went up, bond prices went down. That's the market either discounting stronger growth in the future or higher inflation. And it could be a combination of both, but it's not bullish for bond investors. More bullish for economically sensitive sectors or sectors that help hedge you against inflation. We keep this in mind. This is the CPI for all urban consumers we had this blast off in inflation in 2020, 21, and we certainly have seen moderation. But we want to watch this level here because this is where you might expect it to turn back higher as it has in the past after the first moderation. And maybe that's what the bond market is sniffing out. Maybe it is this pressure to ease along with all the fiscal stimulus that's going on in the economy. Maybe that causes inflation to be hotter later on, or maybe frankly, it's just growth is stronger. But either way, this is not a bad environment for stocks. Commodity prices keep on marching higher. They turned higher back in 2020, and month by month, they keep moving their way higher. We've said this probably points to a relatively stronger economy or a higher inflation number. Gold has consolidated since April, but in a very tight range. I've had people say, is it time for gold to correct? Well, we don't know, right? But when we look at the last bull market that happened during that period where global stocks outperformed from 2000 to 2011, each of the runs in gold price got, in this case, to 80% above the 200-week moving average. The next one was 83% above the 200-week moving average. And when we look at it today, right now, we're about 50% above the 200-week moving average. So maybe this will be a shorter rally than the others. My guess is the internal pressures in the system are probably greater today than they were back after 2000. But there's some clues. First of all, when we look at global portfolio manager allocations to gold, it's still at 2%. 41% of investment managers own zero. 20% portfolio managers own 2%, 14% own 4%, 7% own 8% or more. Well, we would fit into this camp where would be between the miners and gold itself, probably closer to 10. And it's interesting actually because it fits in with, those who own Bitcoin. 75% of portfolio managers own no Bitcoin. My only point is if these assets continue to perform, the folks in this 0% column, one by one, are likely to move small amounts of assets into the buy side, and this can move prices higher. Silver prices have continued to be strong. And again, comparing to the last bull market, silver's up 55% off the 200-week moving average. The first rally back in the 70s got to 350% above the moving average. It go a long way. So commodities are relatively outperforming bonds. So we think that realistically, the risks are higher, that inflation and growth stay strong. Gold relative to the bond market continues to be very firm. And stocks relative to the bond market actually closed at a new high today. So our favorite asset, equities. We own US equities. We're not adding to them right now. We own Canadian stocks more than we would tend to. We've been increasing slowly our weight in global stocks. We started with 5. It's getting closer to 15, including single positions we have and holdings in our global fund. But all of these things, I think, are doing what they should be doing. Now, the US dollar is an important factor for us to watch. US dollar peaked in 2022 after a 10-year long run and has gone through a topping period. And most recently, going back to May, broke the lows from these previous pullbacks. And we retested it from underneath. Interesting again today, US dollar weaker against the basket of world currencies. And the point and figure chart is just a series of lower lows and lower highs. So we have to assume the US dollar continues to weaken at this point. And if that's the case, currencies and holdings outside the US can appreciate. So when the US dollar starts to underperform, it tends to go on for a long time. This is rolling 10-year percent changes in the US dollar, and this may only just be getting going if it's anything like what happened after 2000 or in the 1990s. So these are big structural issues, and they are not charts that would be overwhelmingly impacted by news flow on a day-to-day basis. It can speed it up, it can slow it down. But the number of factors that go into setting up this technical environment that we're in is likely something that is greater than, daily Trump quotes. So euro versus US dollar starting to appreciate over the last 4 months, breaking the trend that's been in place since 2008. That's probably not driven by the change in trade policy in the US. So our job isn't to be everywhere. Our job is to pick our spots, identify the assets that have a structural backdrop that would support a revaluation. Make sure that we see prices doing what we would expect, given what we know. We're watching for change all the time, ready to change our view. In the absence of leadership, certainly we can hold some cash. Our job is to be pretty tactical about this. Three basic pieces to our strategy, just as a reminder. I come at it things from the top down. My job is to understand the macro environment, look at all the various groups that we could focus on, and try to identify where money is flowing from and to, so that we can have money coming in behind us. We know that 70 to 75% of return comes from being in the right neighborhood, right asset classes. Right now, we think equities and commodities, and the sectors that are benefiting from the current backdrop. And then, our job is to see where the money's going, right? From a breadth perspective, where is it that breadth is expanding? In a healthy market or a bull market, over time, more and more stocks should participate. Whether we're looking at the equity asset class right now, where more and more markets are participating, or at the sectors, or within sectors, how many companies are participating in the rally, right? And then we populate the portfolios, finding securities that meet our tests, which are securities that are good getting better, where they're fundamentally sound to begin with, where the technical picture is attractive, and where we see something may be accelerating that could cause that restructuring or revaluation to take place. Now, when breadth starts to contract, we don't know. It could be a short-term issue, either at the sector level or at the market level. We're not making some big call to say we got to go out and sell everything, but it means we got to be a little more cautious. And this is relevant because we have seen some narrowing over the last few weeks in the US stock market. And there's a lot of great performing stocks and a lot of sectors that continue to perform really well. But at the margin, we want to understand what's happening to breadth. Now, we'll see whether any of the data today changes. I looked at it late in the day, not a lot of change now, but if we see some fall through, maybe we see some. But when breadth deteriorates, we raise a little bit of cash, 7 or 10%. We tighten up the stop losses that we use on all of our positions. And if we get stopped out, the money stays in cash. So that's relevant because when we look around the world, we're seeing strength in Canada and global markets. We're seeing breadth a little weaker in US markets, although not all the short-term indicators are negative. Percent of stocks with weekly momentum had been correcting for the last few weeks, got a little better this week. So you can see the price of the S&P is constructive. But you can see the percent of stocks making a 20-day high is down here at 10%. So this is not when you want to be overly aggressive because it's been weakening. Doesn't mean we run out and sell everything. Just maybe be a little more cautious. The percent of stocks over the 50-day moving average has been moving lower over the last couple of months. So that means there's some stocks that are being sold into the market. If I look at the percent of stocks with positive weekly momentum in the US or upward trajectory, in the end of May, 86% of stocks were trending higher. And as we sit today, less than 30% have upward trajectory, have been moving higher. Now we'll see whether this flips. So that just causes us, especially when the seasonality is not with us, just to be a little more cautious. If we look at historical performance from the end of July through the end of September, this is not a great time of year coming in. We have pointed out that when you came in a decent position coming out of July, actually it's not a terrible time of year. If we look at it from an election cycle standpoint, in post-election years around now, there tends to be a little sloppiness. That's not how we make decisions. We just want to understand that that's a possibility and then see whether we get evidence that that's taking place. Volatility at this time of year has a tendency to ratchet a little higher over the next 2 months. So when our breadth data got a little weaker a couple of weeks ago, we raised a little bit of cash. And I think it's 7 or 8% per portfolio. Having said that, the holdings continue to behave really well, and global stocks aren't showing any weakness in breadth. Since April, we've gone from 18% of global stocks in uptrends to 50, and we're basically sitting at the highs. When we look at Asia Pacific, 54% of stocks in uptrends been improving steadily. And this is not one market. This is Japan, it's Singapore, it's Malaysia, it's China. I mentioned 82% of companies in the Japanese market trading above their 200-day moving average. So let's look at leadership and see what message might be coming from the XLF, which we've looked at now for over the last couple of years, the broad-based financials ETF, made up of insurance companies, banks, card companies, exchanges, continues to be really strong, right? These are monthly bars. We're basically sitting at new highs. We're only now 2-3 years having made a new high and gone through a tightening cycle. If we look at the equally weighted financials index, it actually looks better than the market cap weighted index. Part of that is that Berkshire Hathaway has really pulled back, and it's the biggest company in the group. But the US brokers and dealers continue to make new highs. This is as of about 3 o'clock this afternoon. We were basically at a new closing high. Companies like Morgan Stanley breaking out. So Morgan Stanley and JP Morgan have big holdings for us. Part of the reason we think capital markets are behaving pretty well, they should be doing well if capital markets are okay. But also there's a lot of M&A activity taking place and a lot of financing that seems to be lighting up, and these companies will really benefit. We talked about Element Fleet Management last week. This is a company that finances and organizes the provisioning of fleets for companies like, say, Amazon. They provide service as well. Steady relative strength improvement relative to the S&P 500. Earnings have been very, very strong here. We went out at a new high today. We talked about Banco Santander. Boy, what a great week we've had here. Now trading better than 96% of companies in the S&P over the last 52 weeks. And it's still inexpensive relative to US financials. The Euro Stoxx Banks Index is making relative new highs to the Euro Stoxx Index, and the Euro Stoxx Index is making relative new highs versus the S&P. So we got market, sector, and company all working at the right levels. The Eurozone financials are still relatively early in a new bull market. So this is a theme that we want to continue to mine. Now the financials backed off a little bit on a relative basis over the last couple of weeks. Really from a technical perspective, not much to worry about. We're trading above the 50-day moving average, and today back above the 21-day moving average. Aerospace, you can imagine why it may be taking a little bit of a breath. It's had a massive run since the beginning of April, still better than 88% of companies in the S&P. And companies like GE Aerospace, which is about the biggest company in the sector, made a new all-time high today, better than 92% of companies. So I would say leadership in industrials, and especially in aerospace, continues to be intact, not just in the US, but globally. Embraer is one of our large global holdings, better than 93% of companies in the S&P, and very close to making new highs. Power equipment, continuing to work higher, a little better day today. On a strong day, the leadership pop, and the grid ETF made up of the big electrical equipment companies, certainly responded. Golds continue to perform well. That's the gold stock index, senior gold producers. These are the companies that generate cash flow. They're not so much the explorcos, but the junior gold miners also are now making new highs. And companies like Kinross and Agnico, Wheaton Precious Metal, Franco, all acting well. And we think probably have a ways to go. Why do we think that? Well, one of the things that's important in a gold bull market is you should at some point start to see the gold stocks outperform the price of gold. And the question is, why is that? The gold miners are by far the best sector in the market so far this year. This chart, courtesy of Tavi Costa, our friends at Crescat Capital. Well, we talked about this before, but when you've got the price of gold moving higher sharply and the costs moving up much slower, Well, these companies become exceedingly profitable, and they're just churning out cash. So the multiples on these can go higher because, frankly, the ones that have big reserves in the ground and are now financially very secure, having paid down debt, makes them much more durable businesses. And there's opportunity for the multiple to go higher, especially given the fact that people just don't own this group. It was such an underperforming sector for so long. Despite the fact that copper had a weak month last month, the copper miners are responding favorably, having a good start to the month of August. The metals and mining ETF XME sharply higher so far in the month of August, having just broke out of its range. The uranium producers continue to perform well. So materials in general, are a group that we think have lots of room to run and in relatively early stages. We want to own sectors that other people don't own because they come in behind you and they lift prices. So we've stayed with the strongest, most financially secure cash flow generators. You can certainly be more aggressive and go out and buy junior Explorcos. I just would prefer to own the companies that are going to survive no matter what. The one thing we did move away from this week is Nutrien. In the materials, the agriculture space has been a little weaker. This looked like it was making a turn, and perhaps it will hold the moving average here, but we decided to step away just given the fact that, other things are behaving better. So one small change in our materials weight. On communication services, new all-time high for the XLC ETF today. Meta made a new all-time high. It's just been an absolute champ. These companies actually are almost exactly what we're looking for. We want to own companies that don't have debt, that are generating a lot of cash, that don't need financing, so it doesn't matter what long-term interest rates do, and ones that have a catalyst. And of course, AI is a catalyst for companies like Meta and Google. And when you see the revenue growth that came out of this sector over the course of the quarter, you wonder just how big they could become. And while we don't tend to add positions when our breadth models are negative, we did choose this week to reduce one of our positions, Cheniere Energy, and replace it with EA, as it looked as though they were getting prepared to launch their newest game. They launched their first major new game on Friday. They had at one point over 600,000 concurrent players over the weekend. On Twitch, they had 800,000 people playing. And this is bigger than the biggest game in history at the start. So last time we saw this, you could see a stock double over the course of the year. We put on a position on Friday last week, and it's certainly starting out the right way. We'll see. And I'm going to get James Callahan to come on next week and just talk through the thesis here because he's quite bullish. Sea Limited reported their earnings today. This is another one of our global positions. Sea Limited, C stands for Southeast Asia. 70% of the revenue comes from Southeast Asia. Absolutely blew the doors off the earnings. This was a company used to be seen as a gaming platform, is now an e-commerce platform. They have branched out into Latin America. It's sort of an equivalent to Amazon or Shopee. And just to give you an idea, in 2022, they lost $1.75 a share. They earned 25 cents a share in 23, 74 cents in 24. They're going to earn $3.46 a share, up 370% this year, and the expectation another 50% growth for next year. So my guess is revisions are going to go higher because they beat even the most lofty estimates. So communications, we aren't going to fight it. This group is churning out cash, and there's lots of leverage in these big platforms. Technology was a little better this week. Again, making a relative strength new high. Very selective areas, but was very encouraged to see the semiconductors up 3% today on some of the tariff news. And the news that we're going to see companies like NVDA being able to sell into China. Unusual that they are agreeing to pay a 15% revenue royalty to the US government to have a license. But, NVIDIA basically went out at new highs tonight. Broadcom went out at new highs, better than 95% of companies in the S&P over the last 52 weeks. And Lam Research on the equipment side, really surged this week. trading up from $90 to just about 105. So I think the evidence is pretty good. I mean, we are concerned that there are parts of the market that are not performing very well. Energy has continued to lag. Not that it's going down a lot, it's just not making any progress. In the US, the oil and gas exploration production companies really are not performing well. Part of that to do, I think, with the fact they have to continue to find oil because they don't have big reserves. A lot of it's shale oil and gas. But just something to watch. We've taken our position down over the last 2 months. Consumer discretionary really not making a lot of headway. Consumer staples continues to lag. Healthcare, has been horrible. And REITs, get a big impact by a higher long-term bond yield. That's their financing cost. So there's haves and have-nots. Utilities are getting a little better. I'm quite interested by the surge in demand for energy and whether this plays through into the utilities. The bigger ones that are effectively selling power are the beneficiaries, it looks like, companies like Southern Company. Relative strength is getting a little better. So we're watching. If breadth data in the market gets a little better, maybe we'll add something here, but certainly we've got no shortage of positions that are working in this market. So look, at the end of July, the average sector had 50% of stocks in uptrends. All of the sectors in capital letters were showing expanding breadth. Now, last week, we showed that breadth by sector had come down about 5%. A lot of sectors had gone into some contraction, small letters, meaning percent of stocks performing well, had come in. This week, it's slightly better, very slightly better. So we'll keep on monitoring this, right? We keep our stops on all of our positions. Thankfully, our positions are behaving really, really well. We've got a little bit of cash that we can put to work if the breadth data starts getting better. And what it means in the portfolios is that financials continue to be our biggest weight. I did mention we've taken down our insurance exposure over the last couple of weeks. We reduced Intact out of the portfolios after a great run. We did trim in some portfolios our Fairfax, which is the largest position in the firm, just had become very large holdings. Our industrial weight, second biggest weight. Technology still an underweight at 11%. Materials came down a little bit as we trimmed, took out the Nutrien. We do have the 8% cash weight, and then we have exceedingly light exposure in the defensive sectors. So it really is a barbell portfolio. Energy now only about 6%, which is a significant underweight in the Canadian market, still an overweight against the US S&P index. In the income mandate, we're staying with dividend growth. Dividend growth stocks today really surged nicely, so we're really pleased with that. Things I watch and get concerned about, I watch volatility, and yes, at this time of year it tends to pick up. We aren't seeing a sign of that yet, but we'll watch. Financial conditions are easing, and they have been since 2022 when the bull market started. We'll watch for a change in that, but the credit spreads are narrowing and the stock market's behaving. So we have to be evidence-based investors, right? We can't get stuck in a view. The S&P continues to be pretty constructive. Global stocks are pretty constructive. Lots of things to do. Things get more difficult, we'll certainly get more defensive. I know everybody's anxious to know in the month of August if there's something more we should be doing. The only thing that we're recommending people do is look at topping up their global exposure, and we're using our global fund to do it. And if we're trimming anywhere, it's sort of been in US markets, and it's not because we don't think there's lots of opportunities there. There's just some sectors and themes that are not as well owned by so many investors that we think, have lots of good risk reward. So with that, let me just check and see if we got any questions. I certainly appreciate everybody tuning in. I know it's August the 12th. It's the heat of summer, and there's stuff to do outside. Let's see what we got by way of questions. An anonymous attendee is asking our thoughts on Ethereum. That's a great question. So why don't I put up the chart? and we can take a look. So I think most people know we have in our separate accounts a small position in IBIT, which is the ETF for Bitcoin. And, it continues to develop. I'm sharing that. Yeah, I am. Okay. So if we wanted to take a look and compare that to Ethereum's a little bit different. There are some who believe that Ethereum will be the base ledger that financial services will build out applications on and contracts. So we've been watching this. I have owned Ether in the past. We don't own it currently. We have some clients who have some. But certainly, it's having a great run. Over the course of the last, I don't know, 6 months, it's moved from 1,600 to 4,500. Tom Lee is a very strong proponent. If we look at the longer term chart, we're getting very close to breaking out to new highs that it made back in 2021. So look, this is a volatile asset. There's a lot of question marks as to whether, in fact, this will continue to rally. But I think from a technical perspective, we got to give it the benefit of the doubt. Most investors have almost no exposure to cryptocurrency. I would lean first to Bitcoin, which we think has a very constructive long-term price pattern, and it's got the same base case as gold. It's an asset that can't be printed, and for people in countries with capital controls, it's transportable and transferable, and it's very hard for anybody to take it from you. And so it's a safety asset, just like gold. The problem with gold is it's heavy to carry, and it's not as easily transacted in. And so this is a similar instrument to gold, and I think Ethereum is more a base layer to build business cases on. So fairly bullish there. Second question. Let's see what we got. There we go. Stephen, just wondering the next issue, the portfolio holding summary. Do we still own Darden and SITM? Okay, Darden and SITM we have moved on from, Stephen. Consumer has been, a little mushy. We looked at positions we might reduce in the event that markets got weaker, and we wanted to have a little cash. Darden was one we took some cash from, and SITM is another. So we wound up holding our Lam Research, our Broadcom, and our NVIDIA because they just continue to behave well. Question is, do we hold GFB.A? And we do not currently. There's some question as to they do a ton of business with the U.S. government. This is IT services. And there's some question as to, whether it will get trickier for them to do business. And that's it. I think that's all the questions. Certainly, we appreciate everybody tuning in. We get lots of folks on every week. We get lots of folks that watch the recording. We have a lot of people that are too shy to ask questions. If you're too shy or prefer to ask something in private, please don't hesitate to reach out. We have a lot of great conversations with folks through the course of the week. And if you've got something you'd like us to address next week, send us an email, send us a message, or if you'd like to have a conversation, don't hesitate to pick up the phone. That's the value of dealing with a firm that's small. We have direct relationships with everybody. So thanks for tuning in. Have a great week. Bye, folks.